Now that Silicon Valley Bank and Signature Bank have failed, a lot of people are wondering if this is going to spread and if it might affect them. There are some important questions to answer. Let's go. First of all, what happened to cause these bank failures in the first place? Banks operate by borrowing money from depositors or potentially other lenders at a low interest rate and then lending that money out to others at a higher interest rate. As long as they charge more interest than they pay, they have the opportunity or the potential to make a profit. As an example of this, think of your savings account where you might make 1% in interest if you're lucky, compared to a new mortgage that is currently close to about 6%. The bank makes money on this difference, but how can that lead to a bank failure? There are basically two parts to this equation. One of those is the deposits, or the money that the bank takes in, and it has to have some of that on hand, and the other part is the investments and how quickly it can access the money that is in those investments. First, let's talk about the deposits and the amount of cash that banks are required to keep on hand for operations and for when some customers or depositors want to withdraw their money. If a bank were to lend out 100% of the money that has been deposited, then it wouldn't have anything left if you or somebody comes in to pull some money out of your bank account. If the bank runs out of money to pay back depositors who need to access their cash, the bank fails. To ensure that banks have enough cash on hand to avoid this happening and to maintain their operations, banks are required to have about 30 days of cash on hand. And this is to protect both the bank and the depositors. As long as they keep 30 days worth of cash on hand, they're usually able to stay out of trouble. But with a changing economy, some banks have gotten themselves into trouble recently. They ended up not having enough money on hand. They didn't have enough in their cash reserve to maintain enough cushion when customers needed to pull their money out. Since banks do lend out the majority of the deposits that they receive, when customers start withdrawing their money, the bank will need to sell some of those investments to keep enough cash on hand. And that brings us to the investment side of the equation. Banks invest in different types of loans. Some of these loans could be home loans or mortgage loans that they are paid for. They could be loans to businesses who use that money to grow their businesses. There are also loans to the federal government, often through treasury bills, which we often call T-bills. The federal government uses these T-bills to borrow money from banks, from individuals, from large companies, and even from foreign governments. When you think of the national debt, you can largely think of treasury bills. Right now, the national debt is over $31 trillion, which calculates to about $94,000 per citizen and almost $250,000 per taxpayer. Basically, the nation is sinking in debt, and about 80% of that debt is in treasury bills or T-bills. Just like a person getting a loan and paying interest, the government gets loans through these T-bills. And banks buy a lot of treasury bills in order to earn that interest. But the value of these T-bills can change when interest rates start to change. With a 10-year treasury bill, the government borrows money and promises to pay that same amount back after 10 years, but they will pay interest twice a year for the duration of that time. So if you buy a $1,000 T-bill with a 2% rate, you pay the government $1,000 now and get paid $10 every 6 months for the next 10 years, at which point you get the $1,000 back. You could also sell that T-bill to someone else who then starts to collect the interest payments, and they would receive the $1,000 back at the end. Banks buy and sell bills both to earn interest and also to get their cash back in order to meet those cash reserve requirements that we talked about before. But it gets tricky when the rates start to change. Let's say that you have that bill that pays 2% and the rates are the same. A new investor could buy a bill from you and make 2%, or they could buy another new bill from the government for 2%. The value of your bill is basically the same. It earns the same interest and the same return. But if the interest rates go higher or lower, the value of that bill can change accordingly. If the interest rate drops, the value of that bill goes up because investors could get a higher interest rate on the older bill than they could on the new bill. An investor would be willing to pay more for the higher paying T-bill than they would for the lower paying T-bill. But if rates were to go up to 3%, the value of the 2% bill would go down because people could get more interest off the new bill than they could off of the old bill. An investor might be willing to pay only $900 for the 2% bill because otherwise they could get a 3% return buying the brand new bills with the higher rate. When interest rates dropped during the pandemic, investors, including banks, were buying T-bills that paid less than 1% interest. But that rate went up to about 4% and even a little above 4% in March of 2023. The value of a 1% T-bill fell by as much as 25% because investors could get 4% by buying a new T-bill. Banks holding these low-interest T-bills couldn't sell them for as much as they originally paid. By the way, if you're finding that this video helps you understand what's going on, could you do me a favor and hit that like button so that YouTube can know to share it with more people? It really does make a difference getting the video to spread. Now let's put both the deposit requirements and the T-bill valuations together to understand how this leads to a failed bank. Customers at banks like Silicon Valley Bank started to pull out their deposits, so the bank needed to get more cash on hand to replenish that. And one way to do that is by selling the T-bills that they already owned. SVB sold a portfolio of about $21 billion worth of T-bills, and they took almost a $2 billion loss on that because of the changing value. Those old 1% bills just weren't worth as much as the new higher paying bills. This made customers even more nervous, so they kept pulling their money out. The bank couldn't keep up on cash requirements, and that is a bank failure. This is a classic run on a bank. Customers pull their money out faster than the bank can keep up, so they run out and can't function. When this happens, the FDIC, or Federal Deposit Insurance Company, comes in and takes over the bank. This matters because when banks fail, customers could lose the money that they have put into that bank. If a lot of banks fail, it can get really bad. That's part of what led to the Great Depression in the 1930s. So now that you know what happened and why it matters, how will bank failures affect you and what can you do about it? The purpose of the FDIC is to ensure the value of your deposits. In fact, the FDIC was created in the 1930s in direct response to the financial collapse at the beginning of the Great Depression. For individual depositors, the FDIC protects up to $250,000 per account type per bank. You could have $250,000 in a checking account, $250,000 in a savings account, $250,000 in a money market account, $250,000 in CDs. You get the idea. You could actually insure more than $1 million at a single bank by using these different account types. And those numbers double if you have a joint account holder. You really can keep a lot of money safe. And if you do that at multiple banks, then you can protect even more of your money. But if you have millions of dollars at a single bank, you do run the risk that you could lose much of that value if the bank were to fail. And that is why bank failures can be so scary. If you have a lot of money at a failed bank, you could lose your money. But money up to those insured amounts will not be lost. In fact, when Silicon Valley Bank failed, the FDIC came in so quickly that depositors were able to access their money within just a few days. So given these risks, what can you do about it? Well, first of all, if your money is lower than those FDIC insured amounts, you don't really need to do anything. Your money is safe. But if you have more money than that, you can protect it by having different account types at different banks. Then if a bank fails, you are protected and the money at those other banks is also safe. If you're running a business and you have more money in accounts than those FDIC insured amounts, you really may want to consider having multiple banks and multiple account types. Of course, your individual situation may have some unique nuances, so it's always best to talk to a lawyer or your accountant or somebody with understanding of your specific situation to make sure you do get it right. You can also buy private deposit insurance, but again, that's something that's probably worth talking to your lawyer or someone about. I hope you found this explanation to be interesting and helpful. We may see more bank failures for the same reasons that Signature Bank and Silicon Valley Bank already failed. But even if that happens, your money can still be protected and you don't need to panic. Please subscribe for more on business, strategy, and the people involved.